Now, last week we've talked about how we're 90 days away from a recession and interest rates have gone up. And I know there was some negative stuff, and I've had a lot of our people comment on this, but the thing is, if we're going to get there, you might as well get prepared. At the end of the day, if you look at the Chinese symbol for crisis, it's opportunity and crisis at the same time. This is the time where you need someone super creative, someone's going to work hard to get your deal, someone's going to be hungry to do that for you. A lot of people have got mortgages. Well, actually, the whole of Australia, when you think about it, we've got a lot of mortgages. So I thought tonight would be really good to talk about how to save money on your mortgage. Hi, George Markoski with the Positive Property Show, and welcome. How to save money on your mortgage. You know, a lot of people have got mortgages. Well, actually, the whole of Australia, when you think about it, we've got a lot of mortgages with our massive debt at the moment, and interest rates have gone up. So I thought tonight would be really good to talk about how to save money on your mortgage. So I've got Carmine with me, Carmine Alvaro. Carmine, welcome.
Hello, everyone. How are you?
Excellent, excellent. Good to see you, mate. Now, dive deep into that, but first I'm going to start the State of the Nation, talk about what's happening. Now, last week we talked about how we're 90 days away from a recession. And I know there was some negative stuff, and I've had a lot of our people comment on this. And look, we don't know if we're going to be in a recession in 90 days, but the thing is, if we're going to get there, you might as well get prepared. And I'm going to go through the stats every week to guide you through and show you what's happening, so that way it's not a surprise. Because at the end of the day, you know, if you look at the Chinese symbol for crisis, it's opportunity and crisis at the same time. So that's the fact of it. So what I'll do is I'll go to the State of the Nation, talk about what's going on, and then we're going to dive deep on how to save money for your mortgage. If you've got any mortgage questions or finance questions, now's the time to type in the chat, whether you're in our private group or Facebook on our live group. Type it in, because we're going to be going through it all. Okay, Aussie inflation roars higher. So basically, private inflation data is rising before the official CPI. The Melbourne Institute gauged basically printed 1.3 MOM and 4.2. So this is a sharp move and higher. So it's already started and it's building again. This reminds me of what happened during the COVID pandemic. So consumer inflation expectations are climbing higher. They're moving back towards the 2022-23 levels. So markets look stable, but households expect higher prices. I don't blame them with all the news and what's going on. And this is the challenge, right? Input costs remain elevated across the economy, but businesses are struggling to pass it on. So what happens then is margins get squeezed. And when margins get squeezed, it's harder to make a profit. So this creates a lot of challenges. And we saw this during COVID as prices went up. And then during COVID, it was a lot worse, because what happened during COVID is input costs went up, but also output. People couldn't sell anything. It was really difficult. There wasn't services, so it collapsed completely. Luckily, the government stepped in and sorted this out. So let's see what happens this time. But this time round, it's not as bad, because we haven't closed the economy down. The economy is still going. It's just having challenges. And unemployment is higher than it looks. So the unemployment rate hasn't really changed, but 20% of the workers in the employment force are underutilized, and that hasn't been shown through the official figures. So it's a lot weaker than what it appears. And this is the big challenge. Population growth is running ahead of job creation, which means more competition for fewer opportunities. So hiring data looks very positive, but it lags reality. And this all comes down to Labor's beautiful policy of having the biggest immigration year we've ever had in our history. And that's why the population growth is running ahead of creation. And what they're saying is AI could push unemployment higher. So AI adoption is accelerating across industries, and some estimates say that unemployment could rise above 6%, up to 1.2 million jobs. I'll give you my take on this. I think this is actually utter BS. I'll tell you why. When something new comes out, what happens is you actually create more jobs initially anyway. So for example, you look at when CDs came in, and CDs, to manufacture CDs, it's a lot quicker and easier than what it is with vinyl records, a lot less labor, and everyone said, that's it, everyone's going to lose their jobs. But the music industry got a lot bigger. And then Spotify hit, and the music industry is bigger as again because people are still spending money and a lot more money, and it's in their pocket. And everyone's paying for Spotify like every week. So this is the thing. High energy prices are adding pressure to the economy. If oil rises any further, unemployment could spark higher. This is not a normal cycle. It's all to do with the war with Iran. And Australia's population is growing rapidly. Hundreds of thousands of people entering the workforce. Job creation is not keeping up. So there's more workers competing, which means high unemployment long term. And energy pressure is not going away, right? So the gas shortages are keeping supply tight. That puts more pressure on prices to push them up because lower reserves mean less buffer. High energy costs feed inflation. Now, look at Australia here. Australia is one of the most diesel dependent economies in the world. Look at this. Australia, how many barrels we use? We use 7.7 barrels per person. If you look at Australia compared to Saudi Arabia, in Saudi Arabia, right, they're drinking their own oil because they produce it all, right? We do produce oil as well, but not a lot of diesel. However, we don't use a lot of our own oil. We'll import it all, which is crazy. And you look at the US, they even use less. Now, the reason we use so much crude in Australia is because Australia is such a big country for small population. And a lot of this diesel is used in long haul trucks. Basically, we have a lot of truckies moving a lot of stuff backwards and forwards in Australia. Look at this. Just proves what I just said. Look at transport. Transport uses the most diesel and jet fuel and petrol, then mining, agriculture, manufacturing, utilities, construction. So a diesel shock would hit the economy hard. And what would happen is we'd lose money in mining, construction would slow down, transport will slow down, and a little bit of agriculture. Not as much as what we thought it would. Now, look at this. A massive fire engulfs one of Australia's last two oil refineries. This is crazy. I'll tell you the story. This one here is in Geelong. And what happened was they decided to push it to 100% output. And oil refineries, this is an old oil refinery that probably hasn't been maintained that well. It's never really been pushed hard for a long time. And they actually warned that if you push it hard, something might happen. They put it at 100% capacity and it broke. So they should be able to fix this pretty soon, luckily, but it's crazy how this can happen. And population growth is accelerating again, right? It's basically accelerated after the post-COVID reset. So guess what? Demand for housing is going up as well because all these people coming need somewhere to live. And demand has overwhelmed the rental market. So population growth is surging. Rents have risen over 48% since 2019, and demand continues to outpace available housing. This is pushing rents higher and higher. We had a little dip for a little while, and now it's been reset again and it's pushed up again. So rental supply is collapsing. Rental listings have fallen sharply across capital cities. So this is the lowest level on record for this time this year. We just don't have enough houses. This is the least amount of listings we have had in history compared to the population size. And vacancy rates are going down as well now because of the rental demand and having nothing available. People are competing. It's like the Hunger Games of getting a rental property at the moment. And we're just running out of rentals, right? Basically, you look at this graph. Without new housing, rental pressure is going to keep rising. Demand is just continues to outstrip supply. And government policy, as usual, is inflating demand, which is going to happen, which really sucks. So what I want to do is let's get back to Carmine, and then we're going to go through our wins. Okay, so that's the state of the nation in a nutshell at the moment. So it's fascinating because what's happening is we're heading for a recession. Inflation is going up because of this whole oil thing, and businesses are struggling, but we just don't have enough housing. So it's a weird position to be in, but there you go. So let's talk finance.
Let's do it.
Yeah. So look, Carmine, you've been working with Wall Street you just joined Wall Street recently, so welcome. But also you've been working in property and finance over the last decade.
Yes, so I've been in property and finance for about 10 years now. So pretty much straight out of school, jumped into it. Been, I think, about 10 years now.
Yeah. So, you might look young, but you've got a lot of experience, which is great.
Yeah, yes.
And
So
Vero, that sounds like an Italian background to me.
Alvaro, yes,
Yeah.
Italian
Yeah,
background,
exactly,
yes.
exactly. And look, you've got the Italian work ethic. You work hard. You don't care. You just get the job done.
That's right.
I know when I send you a message, even if it's 10 o'clock at night or a Sunday, you're replying straight away. I love your work ethic. You've got a strong work ethic. And that is really important because, when you get yourself a mortgage broker, you want someone that's enthusiastic, that wants to make the deal happen because you need that. You don't want someone that's going to sit around going, yeah, whatever. You know what I mean?
Exactly right. And what I've learned in property and more so in finance as well is that a lot of the time it's not about it's about finding a way to get it done. A lot of the time it's kind of, if it's short-term pain for long-term gain, that's kind of how you have to look at it sometimes. Even if it's, you're in a position where it might be not getting the optimal, interest rate, or you don't have the optimal deposit size or anything like that, rather than waiting, a year to save that deposit or waiting for the interest rate to drop or things like that, you're going to be better off kind of jumping in and finding a way to get it done rather than waiting, because by the time you do that, you've either missed out, or that property that was 700K in 12 months time is going to be 750K.
What you're saying makes a lot of sense. And really, what you're saying is people need to know what's important, right? Because what
Yeah,
happens is people get confused, and what they do is they create a complex equivalence. It's an interesting term because what means is one thing means another, but it's not true. So, for example, people think, a lot of people old school used to say this, and it used to work a long, long time ago. They'd say if you buy a property within 8 kilometers of the capital city, you're going to make money, right?
yeah,
That's a complex equivalence because have people made money buying 8 coasts in the city? Yes, they have. Have people lost money buying 8 coasts in the city? Yeah, they have too, right? But also, the other thing is what people have to realize is that property is 8 coasts in the city. People already knew that. They've already priced that in. It's not a
yeah,
surprise to people. People are like, wow, it's 8 coasts in the city. I didn't realize that. No, they already knew it before you were there, right? So
yeah,
whenever whenever you got information that someone has already got, it's a bit late anyway, right?
yeah.
And
That's
so, and then some people go, okay, what I want to do is I want to buy a house near a school because they're thinking near a school could be good. Now, it could be good, but you can buy a house near a school and not make money. You can buy one and make money. But
that's
then
right.
what we do is we look at, okay, is there less supply, more demand for this house, for this area? Now, suddenly, if you buy a property and there's more demand for that property in the future and less supply, is that going to go up?
Of course. Yeah,
Every time, every time. And if you buy a property where there's going to be less demand and more supply, is that going to go up?
of course.
If there's less demand and more supply, no. And that's the
No,
fact of it. So what we're going to look at is the fundamentals. And then people say to me, they go, George, okay, what do you think of mortgage insurance? Right? A lot of people ask me this question because they're like, oh,
yeah,
I'm buying this property and they want mortgage insurance. And I'll tell you my opinion, what I think of mortgage insurance. I prefer not paying it, right? That's my
of
opinion,
course.
right? I prefer not paying anything that I cannot pay. However, I would not let a thing like mortgage insurance get in the way of a good deal because that's stupid. Because when you're getting a property deal, the fact of it is, when you look at property, property is one of those things in Australia where it keeps moving forward. It never stops. If you look at the last 100 years in Australia, it's been just slowly at 5 to 9%, just creeping upwards. It's a
Yeah,
rolling train that just keeps moving. And if you don't jump on that train, it's moving past you. And whatever price you're going to get a property today, you ain't going to get that price tomorrow.
that's
Right?
right.
And
That's right.
and the thing is, then suddenly you're buying a property of 700,000. And how much is mortgage insurance on a property? If on a loan of five, let's say you've a $700,000 property, you got $100,000 deposit. How much mortgage insurance are you paying?
It depends on lenders and their insurers and things like that. But roughly on, say, a $700,000 loan, you're probably looking at around, give or take, about 20 grand, roughly,
Yeah. Okay.
in that
Yeah. Give
insurance.
or take 20 grand, but you got 100,000 deposits, so probably a bit less, probably 15 grand, I'd say. Yeah,
Yeah.
yeah, because it's not a whole $700,000 loan. So you got 15 grand there, right? And you think, okay, I don't want to pay this 15 grand on the $700,000 house. So what I'm going to do is I'm going to wait and get a bigger deposit, right?
Yep.
Now, the problem is that house is still growing. So
Correct.
in a
Yeah.
year's time, you save more money, but you probably don't have enough to miss the mortgage insurance. So then you're
Correct.
paying mortgage insurance on a $750,000 loan instead, which is what? More.
Yeah. A lot more. And
Three, three or
that was
four,
my
three
point.
or 4,000 more. And the
Yeah.
other thing is, though, the other thing is the opportunity cost, right? Because that $700,000 property has probably gone up 30, 40, 50,000. You've
Correct.
saved, and even if you saved enough money to miss out on the mortgage insurance, you've saved 15 grand, but it's going to cost you another 35 to buy it
Correct.
at the
Yeah.
best case scenario. And so you're still
Yeah.
losing money. And that's the thing, because you can't try to save pennies. You got to look at the big picture, and the big picture that you got to worry about. People worrying whether you overpaid 5 grand for a property or 10 grand, it's pocket change. It doesn't make a difference. There's no way of knowing that because the valuation, the price, whatever, it's one of those things. Because what you want
Yeah.
to do though, you don't want to overpay for a property. That's one thing. So you got to do your due diligence. You've got to make sure you pay a fair market price because, if you overpay for a property, that's not a good thing either. That's a bad thing, right? If you just go willy-nilly and go blind to a property, you need to do due diligence and make sure you pay a fair market price. And that's the way to do it. And so the important thing is don't let silly things get in the way. So what do we want? We want no mortgage insurance. We want a low interest rate, really good deal, least amount of paperwork to get that done. But that's a unicorn. Doesn't always happen. Sometimes it happens, sometimes it doesn't, right?
I was just about to say that exact word. So the clients that kind of I guess come to me and well most mortgage brokers really those unicorn clients is kind of what we call them where they've got a couple hundred grand saved, they've got no other debts, they've got clean credit, they've got
They're a
like
police
everything.
officer, so they get a special rate, or a doctor or a dentist or
Yeah.
something,
So
right?
exactly. So for the purpose of what I said before and what you just kind of explained there as well, it's more about finding the best solution for your scenarios because everyone's scenario is completely different. And even in terms of the lending side of things, if you are in a position where you can get the loan, but it's going to be with a second or third tier lender that's going to be charging you, say, just use a worst case scenario at the moment on an investment like interest only loan, say your Liberties or something like that, that's 8.5% compared to a 6.5% rate that you might get at an optimal lender. Yeah, you're going to be paying maybe on a say 700 grand loan, maybe about $1,000 a month extra in those repayments,
Yep.
plus say lenders, mortgage insurance, and all of that. But in that year, say you've spent an extra 20 grand in interest and in the insurances and things like that,
Well, you get a
that
bigger tax
property
deduction,
for
correct?
the tax deduction number one,
Out of
and
that, out of that, you're going to get between 30 to 50% back,
yeah,
right? Anyway,
yes,
so that's one good
yeah,
thing.
tax deduction, and as you said as well, obviously that property that you bought at 700,000 today in 12 months time, once you paid that extra say 12, 15, 20 grand, that property is probably going to be growing 50, 60, 70 grand, so you're actually still ahead.
But then people are going to say, hold on a second, properties don't always grow every year, which is
Correct,
true,
that's
right?
right.
And what if I bought this property, I paid the mortgage insurance, and it didn't go up next 12 months, which can happen, right? That's the fact of it.
Yep.
That's a fact. However, that's a very small percentage of the growth cycle. So if you look over the 10-year cycle of a property, properties double around every 10 years. And what happens is they grow and then they do nothing. But you don't know what part of that cycle they're going to grow quicker. But the key is you want to own that property for as long as possible because you get more chances at getting that growth by having it earlier, right? So every year delay, you might miss that window, which is going to cost you a lot of money. That's why the sooner you own
Yeah,
property, because when's the best time to plant a tree?
whenever you plant it.
20 years ago, 20 years ago, because then it's
Yeah,
fully grown, it's giving you fruit and everything else like that, right? And then you're thinking, okay, I want to plant one this year. Well, by building it, planting it now is better than planting it in a year's time, isn't it? Because you're going to
yeah,
get a grown tree faster. And so with property, it's the same thing. Like, you know what I mean? So that's what you got to think about.
exactly. Exactly. Like I was saying as well at the start, it's a lot of the time it's just finding the best solution and a means to an end, and short-term pain for long-term gain. And in those scenarios where you are in those kind of positions where it's going to be a little bit tough in the first 12 months, there are certain products that have only recently just come out and been available to brokers where we can actually, in the first 12 months, as long as you have a clear 12-month repayment history at that higher rate, we can refinance you to another lender without showing anything like any pay slips or anything like that. Literally, all we need is 12 months clear repayments. From the
Exactly.
lender's point of view, if you're paying a 7.5% rate, but their rates at the moment they're about 6.5%. If you've made 12 months clear repayments paying that higher rate, then obviously you're going to be able to afford the lower rate. So they don't have to look at your incomes if your incomes change or anything like that.
Exactly.
It's
And
a
look,
pretty simple
what
process.
you're saying, I've done with you already, and you've
Yes.
saved me thousands of dollars every month. Because a lot of
Yep.
people watching this, they
Often
probably
wonder.
think, a lot of people watching this, they probably think that I always get the best rates when it comes to property deals because I've got so many properties, I've got so much experience. It's not true. That's the
Yeah.
fact. That I wish it was true, but a lot of times because I've got so many properties that I a lot of times go low doc and pay the biggest rate. But then what I do is, and this is what I love about what you do, I come to you after a year and then flip it back over. And it's much easier because you got a choice, right? You can pay extra tax and do all this extra stuff. So then you get a lower rate, or you can just get a lower rate if you're a business owner,
Yeah.
go low doc, but then transfer it over and go for a bit of pain for 1 year. It doesn't matter because
That's
it's
that's
just
right.
it's just a matter of numbers, right? And
Yeah.
so depending, because if someone's got an ABN or if they're self-employed, you get a lot of different opportunities at giving them a loan compared to just the pay wire. Pay wire probably easier because it's very
Yep.
simple. You got your pay slips and that's it.
Yep.
But a business owner can be more complicated, but also gives you more opportunity because there's more leeway as well.
Correct, correct, and that's part of, I guess, using a broker as well. Obviously, in the past, before brokers were a bit more prevalent than they are today, we're over, I think, out of all the loans in Australia, it's about 80% now that goes through brokers rather than go to the bank directly. Before that
Well,
was obviously
well, I
a
mean,
turn.
yes, because everyone used to go to the bank, right? But in the old days,
Yeah,
it was easier going to the bank because I remember when I was buying property in the 90s, because I'm with ANZ, and I'd drive past the house, see a sign, get on my mobile, call my bank manager and say, hey, I saw a house that I'd like to buy. It's 550. And my bank manager goes, I'll call you back in half an hour. He rings me back, goes, yep, you can
all
get
good.
that. Seriously, from a phone call, he would approve
Yeah,
me, right? Now, each year after that, I had to fill out a bit more paperwork until now where, my God, and really I just can't be bothered anymore, right? So
yeah,
the only time I refinance is if I'm doing a deal because I
yeah,
just cannot be bothered. But sometimes it's worth refinancing because to save money as well. And that's what we've done with you. And because of the way we do it, I don't have to fill out any paperwork, just give you 12 months worth. It's really simple. And we're going to be offering this to our members as well, because if any of our members, if you're paying too much interest at the moment, well, you need to book in with Carmine. Later on, we're going to give you a link because you're going to be able to save money without having to do all the refinancing. It's a really simple process and it works. And basically, Carmine won't even do it unless it can save you money. That's how simple it is. Because it doesn't work if you don't save money, right? Because the whole
correct. Yeah,
premise is if you could afford it at a certain interest rate, then this bank doesn't need to know anything about you except that you could afford it at that rate because they're giving you a better rate. Smart business model, brilliant. It's
yeah. It's a really good product, and it's something that we're using a lot now because yeah, basically of the ease of the process. Obviously, there's still like IDs and that
yeah,
type of
of
stuff,
course.
but yeah, in terms of the other process side of things, it's quite quick and easy. Yeah, just generally kind of speaking, in terms of a broker's perspective, rather than the lenders. The reason why there are other lenders that will allow you to do different things and even allow you to borrow a lot more money is basically because every single calculator that we use for each different lender they all have different requirements and they all have different parameters in their calculator that allow you to borrow X amount of money, or they'll, for example, will shade your rental income to 75%. Some will take 95%. So it does depend on a lot of scenarios. Rather than just giving you a number of the rate, you might get 50, 100, 150 grand more somewhere else and paying, 2 points or 3 points extra. That's not really going to hurt the pocket, but it's going to get you that house that you want, or
Yeah,
whatever.
exactly. What I like about what you're saying is, you see, mortgage broking is actually not just a science but an art as well that people don't realize, right?
Yeah,
And the fact of it is, you've got to have a creative mind to create solutions, because
that's right.
if you just get a robot that just sits there and takes your details and just puts it through the normal stuff they put through, you're not going to get the best rate. You're not going to get the best borrowing capacity that you should get.
Yeah,
And that's why I really wanted you to join our team, because I've seen some of the work you've done and it's really good. You get people's borrowing capacity up, you get them over the line, and that's the most important thing, because the hardest thing at the moment is borrowing capacity, right? Getting that borrowing capacity
yeah,
up. It's difficult. It's very difficult because we've just got rates gone up. People's borrowing capacities are tough. This is the time where you need someone super creative. Someone's going to work hard to get your deal. Someone's going to be hungry to do that for you. And I like the way that that, okay, if you've got a certain amount of rentals, some banks are terrible because they shave it off. And if you're in
yeah.
certain jobs, other banks are better. Because really, at the end of the day, if you get the right fit, you're going to maximize someone's borrowing capacity, because different institutions, different products are targeting different people, different types of people. Is that right?
Yeah, that's right. That's right. Like, for example, some lenders are really good for self-employed clients, and some only look at self-employed clients and don't look at PAYG at all. And then there's other scenarios as well, like in terms of if you're not a permanent resident, if you're on a visa or whatever there is. Yeah, again, we have, like, on our panel through our aggregator through Loan Market, we have about 75 lenders that we can use. Reality of the situation is, whichever the client is, most of the time there's probably maybe 4 or 5 that will actually fit their scenario.
Hmm.
But what I always like to do is give you kind of different options where we say, hey, this is the best rate available for your situation. This is what they're going to let you borrow. This is, like, I guess, the best way to go in terms of repayment wise and things like that. But if you want to maximize your borrowing capacity, this is another lender we can go with. This is a difference in rate, and then basically decide what you want to do. It's not about pushing you into things you're not comfortable with, or you're telling you this is the only way you can do things. There's always going to be different scenarios, different solutions. And at the end of the day, it's completely up to you, because it's your asset at the end of the day. We're just here to help as best we can.
Yeah, exactly, exactly. Someone just commented, Robert Fulton commented, RBA mentioned this morning that if the Strait doesn't open, we'll be in a recession. Well, yes, Robert, that's what I was explaining last Thursday about the oil crisis. The thing is, Trump recently said that it's going to be open in 48 hours, but the boy who cried wolf, he cried wolf quite a few times. So we'll see what happens. I don't believe him. I hope it's true. I'd love there to be a peace deal. Less killing, more oil going everywhere would be great. But if it happens, I wonder if the pressure's going to be up on him. I hope so. The thing is, I suppose, if we have a recession, we're going to have to just deal with it. I hope we don't, but we'll see what happens. Yeah, because a lot of people ask about fixing rates, right? Should you
Yeah,
fix your rate? And I've done the numbers because I like doing stats. And if you look at the last 30 years, if you fixed your rate, you'd be you'd cost you more money 75% of the time. If you went variable, you save more money 75% of the time. But 25% of the time, you actually make more money by fixing rates. So what do you do, right? That's the question. Now, I know a friend of mine in Queensland, he's got a lot of properties. He's got like 200. And what he does 50-50. He does half fixed, half variable. So that way he goes both. But I would say if you're a gambling man and you look at the stats, I just personally think variable is just works better, because you got a 75% chance of saving more money. What are your thoughts on that?
yeah. These are one of the things that a lot of the time is kind of down to personal preference as well. Like, we'll always give the option of what is out there on a fixed and a variable rate. The thing that kind of determines that decision a lot of the time as well is the offset accounts. So if you're on a fixed rate, 99% of the time, the lender will cap you at, say, 15 to 20 grand that you can offset that fixed rate from, because they're locking you into that rate.
Yeah.
So if you want to make use of an offset account fully, especially if you're doing interest only, because that is like the full maximizing of the offset account. Like if you've got extra savings that you want to put in to offset those payments, a fixed rate is just pretty much not going to work. If they want like even just a year fixed rate and they say like, I'm having a kid in the next 6 months and, we're going away, I want to make sure that my repayments are always going to be this amount every month or whatever. But it is up to preference a lot of the time too.
Yeah, but also rapid mortgage reduction. If you want to reduce your mortgage, you need a big offset account and you need to put
Yeah.
everything in it and you need variable. Because my personal preference is variable rate, interest only, massive offset account, put everything in it. Like I'm talking every cent that I have, live off the credit card, pay it off. So even your bills are sitting in your offset account. And this is the way
Yeah.
I pay off mortgages really quick. I paid off a house in 2.5 years once by doing it this way because I've got all my rent going in and you're paying no interest, right? And when you're paying less interest, you can pay it off quicker because
Yeah.
interest is the biggest expense. Because if you got money in a savings account, you're making sweet FA. But in an
That's right.
offset account, you're making good money, like
Yeah.
6, 7, 8, 9%, depending on your loan. So
Yeah.
I personally, I'm very much into variable. I'm very much into offset accounts. I think anyone that gets a loan without an offset account is just stupid. Doesn't make sense.
Yeah.
Yeah.
Now, again, it is up to preference a lot of the time, but look, sometimes obviously when, we're talking about COVID times when it was, 2% rates or whatever it was, and
Yeah. Yep.
probably should have fixed it for 5 years. But those are, again, kind of think scenarios that are going to pop up every once in a while, I guess.
You couldn't fix it for that low rate anyway. It was higher, the rate, the long term.
For long term, yeah, 2 or 3
Yeah.
years, we're about 2%. Yeah.
That's what I'm saying. They put it up. So what happened? I
Yeah.
mean, what we should do is Denmark had negative interest rates during COVID. That's where I wanted to get a loan. But see, the thing is, when you got currency, it gets way more complicated. And even though it looks good to get a lower interest rate with different currency, it actually can be problematic, all right? Because for example, like I'm building a house in Bali at the moment, and I bought some land and it cost me 1.2 mil. It's gone up in value, but the Australian dollar's gone up. So it hasn't moved. So
Yeah.
even though it's gone up, because the Australian dollar's worth more, and now I'm building a house, and instead of it costing me 1.2, it's only going to cost me a mil. So I saved 200 grand because the
Yeah.
currency's gone up. But the thing is, the currency can go up and down, and it makes a big difference to what your value is if you move it to another currency. And it's a
Yeah.
lot more complicated. So, when I was seeing those negative interest rates in Denmark, I was thinking, I'd love to get an interest rate there. But imagine the currency moves, and then suddenly you're 5, 10% on the other side. It's not going to work.
Yeah. That's right.
But it'd be good to get a negative interest rate. That's good. Where that bank pays you to get money.
Yeah. I think we'd
Yeah.
all like that.
Yeah, they wanted to encourage people to spend money. So they were actually charging you to have money in your bank, but not to get a loan.
Interesting.
Yeah. Okay. So let's have a look here. Okay. So apart from the obvious, how you pay less interest, lower rates, interest only, offset against the loan, payments more often. Yeah, basically that's the way it is, what Tim said. So the obvious is get whatever loan you can get, but do the best deal you can. And then if it's not the deal you want in 12 months, what you can do is go to someone like Carmine and get it refinanced or do a full refinance. Because what you're doing is like a mini refinance. It's like when the Hollywood stars, they go for a mini facelift and then every 10 years they go for a major facelift, right?
Yeah. That's right.
Right. It's difficult to refinance as well. So had one broker saying he can get me 5.99% interest only, but then bank mortgage choice knock it back on location and NDIS. Trump is making a lot of money out of this literally. Yeah, he is. Yes, NDIS is harder to get a loan for NDIS.
Yeah, so NDIS is one of those things where certain lenders will do it, certain lenders won't do it,
Yeah,
depending on parameters. It's the same as self-managed super funds and things like that. So,
yeah. But anyway, I don't recommend doing NDIS anyway. I've got a full podcast explaining why you shouldn't be doing it. It's when you're relying on the government to make money, it's not going to go well because they can change policy anytime and
Yeah.
suddenly you're held holding the baby. This happens all the time. And
Yeah.
NDIS, as far as I'm concerned, it's the biggest scam ever. Like it's
It's
cost,
coming out now a lot. That yeah, it's all over the news at the moment.
it's a huge scam. I've been saying this for years. It's ridiculous. There's all these people making millions and millions out of NDIS that aren't providing good value. And we're not using our resources properly. NDIS costs more money than our age-old pension in Australia. You know what I mean? So,
Yeah.
you know, I'm all for looking after people, but we employ more people in this industry than any other country. It's just ridiculous. Now, it's a very much a Greens and Labor thing, right? But it's almost like they work for the government. It's ridiculous. I'd prefer a smaller government and less people sucking up the teat of government. We shouldn't be a communist country and we should be more capitalist. Yeah, NGOs is full of issues, definitely. It is. So, does having a credit card to use for interest purposes affect your borrowing capacity? Is it always useful to use a credit card?
Any kind of debt will technically affect your borrowing capacity. Yes. So if you have a credit card, even if I get this question a lot actually, especially with first home buyers and things that have credit cards. If you have a credit card that's you got a limit of 20 grand, but you clear it every month and there's zero owing, it doesn't matter. 20 grand is your limit, so that's your debt. It's the same as having a home loan. So if you've got a $500,000 home loan and you've got 300 grand in the offset, so you're paying repayments on the 200. Again, doesn't matter when it comes to borrowing more money. Your limit is 500,000, so that's what we have to use as a debt.
Yeah, I think the banks are just the way they look at things is ridiculous, very simplistic. Because I think if someone's got 200,000, 300,000 in their offset account, these people know how to save. You can trust these people, right?
Yeah, there's a couple parameters that like quite ridiculous when it comes to the lending. Give you two examples just quickly. Like talked about this a little bit before, but a reason why a lot of the second and third tier lenders will allow you to borrow more money is because their calculator has a 1% or 2% buffer depending on where it is. The
Yep,
big four banks and the major lenders have a 3% buffer. What that
yep,
means is if the interest rate is sitting at 6%, the calculator is making you service a 9% interest rate.
yep, yep,
So when you go into a smaller lender and they're only putting 1 or 2% in that calculator, and that includes all your other debts as well, some of them won't put any buffers on your current debts, only the new debt you're applying for. This is all a little bit in the weeds, but that's a really ridiculous parameter that a lot of them have, because why would you need a service of 9%? And one of the other ones, especially for investors like most of you guys on here now, is notional rent, which is another ridiculous expense that they put in there, which means if you're living at home with your parents, you're buying your first investment property, or you've just moved back in with your parents, even if you're not paying any rent, because obviously you most of the time you're not going to be doing that, or board, they still account for $650 per month per applicant if you're living at home. So if your
yep,
two
yep,
brothers looking to buy your first investment property, but you're both living at home, there's $1,300 a month that we have to put in the calculator that's not even there.
yep.
Again, second and third tier lenders like a Pepper or a Latrobe or a Liberty, they don't account for any of that, which obviously boosts your borrowing capacity there.
Yeah, so look, I feel like this is a real big hack, right? Going to the third tier lenders, getting a loan, have 12 months of payments, don't miss any, and then flip it over to a cheaper loan. That seems like a real good go through 1 year of a little bit of pain, but higher borrowing capacity, then flick it back and save money for the rest of your loan. That sounds amazing. That sounds like a pretty good idea, if you ask me.
Yeah, look, it's a much easier process, and again, it's one of those things where like their rates at the moment are pretty much around kind of the market rate as well. So you're not getting a higher rate. Yeah, it's pretty much around the same rate. And like with any home loan or refinance, if a better deal comes available, then the better deal we go for. So
Yep,
in 6 to 12 months or whatever it is. So yeah.
yep. Exactly, exactly. Someone said, what is the Amex Platinum with no limit? I know the answer because I've got one. So I
Yes.
spend 3 million a year on my credit card. So what I do is I reduce my limits when I'm going for a loan for a month and then push them back up again.
Yeah, so you can do that, or if there is no limit credit cards, most like with the Amex, with a few clients I've done before, they basically just take the average of the actual
That's what I yeah,
debt
that's
you've
what I do.
had over
Yep.
the past 3 months. So if you
Yep.
spend 20 grand, 20 grand, 20 grand, they'll take 20 grand as your limit.
Yeah, because I spend so much on credit cards. Because
Yeah,
basically all my expenses are on credit card because I keep all my money in my offset account for all my properties. And it
yeah,
works really well. But obviously the banks don't like me spending that much on the credit card. Because
yeah,
the thing is though, they don't look at my expenses and go, hold on a second, it's all business expenses. It's not as if he's having caviar and cigars and hiring out the penthouse and having big
yeah.
parties or anything. It's very different about what you spend your money in as well. But they don't care, do they? There's no
No,
nuance. There's no nuance there at all.
no,
And
no. Right.
I haven't paid credit card interest in over 30 years because I pay it off every month because
Yeah,
it's ridiculous. But I use the credit card for my advantage, getting a free loan for 40 days.
yeah. That's right. That's right.
Yes. Okay. So let's go here. Does having a credit card to use for interest purposes, now we already did one, given that interest payments are tax deductible anyway, is it better to leave 100,000 in a high interest savings account or an offset account? I don't currently live in a property I own. Good question, Jane. And I'm happy to answer this. You're never going to get the high enough interest on an interest account, right? And also, you get taxed on the money you make. So if you put $100,000 in a high interest account, whatever you make, you're going to have to pay tax on it. However, if I get that 100,000 and put in an offset account, I'm going to get a higher interest back because I'm saving money. But because I'm saving money, I'm not actually paying tax on that money, so you're going to get more benefit. You make a lot more money out of having your money in an offset account than a high interest account. That makes
Thank
sense.
you.
You're
Answers
welcome.
that?
You're welcome. Hope that makes sense.
Yes.
And look, what I might do now is I might go into our private group so we can go get down and dirty with more interesting stuff. Okay, let's switch off the public group. Everyone else, thank you for watching. We're going in our private group. See you next Thursday. And look, if you want to save money in your mortgage, right, what I want you to do is type in hashtag save, and I'll get my team to reach out to you and connect you with Carmine. Thank you.